All right, Ashish Gupta joins us now, CIO with Axis Mutual Fund. Let's understand from him what he makes of the current market construct. He tracks the banking space. Yes, I've interacted with him in his previous avatar with a magnifying glass, so he's got a very deep understanding of what is happening there. And in general, let's understand from him what his take is on the global macro. So, Ashish, so nice to have you on ET now. Thank you for joining us. What do you want to start with?
Right.
Banks, macros, or valuations?
Whatever is your preference.
Okay, let's start with the macros. And it was more like a bolt out of the blue when US Fed actually upgraded their guidance or US economic guidance for next year. What would be the implications of that? Because at the beginning of the year, the narrative was that US will slow down or hit a patch of soft landing and China will come back and it will surprise everybody. Well, the surprise has come, but it is opposite of what we anticipated.
Sure. No, I think you are absolutely right. The global macro has surprised this year, but I think the positive surprise has primarily been only from the US. And if we look at global growth in aggregate, while US has surprised positively, Europe has surprised negatively, and China, as you mentioned, has been a negative surprise. But even more concerning is the fact that some of the challenges with China appear to be a bit more deeper and structural rather than just cyclical. And that means that this headwind for global growth, because as you know, China for the last 15 odd years has been one of the power engines for global growth, is going to last. And what this means is that global growth is likely to be just about 2% or sub 2%, not just this year, but probably next year, despite the fact that the Fed has raised its outlook from about 1% to 1.5% for US GDP growth for next year. Even there, I think we should also not take the Fed outlook at face value. Because if you watch his interview, actually the Fed was at pains to highlight that a lot of its forecasts are just that, they are forecasts, and they actually downplayed the importance of their forecast and the dot plot, and highlighted that moves from here on will actually be really much more data dependent. And I think that is something we need to keep an eye on, because I think we have to be prepared for a much higher bout of volatility, because central banks are moving into really a space of uncertainty. I think it's not very clear whether rates are going to stay high, rates will come down, whether central banks will be hawkish or dovish. And for the last, 13, 14 years, we have seen central banks set the mood for the markets. And we have seen that this year as well. During the phase, the Fed was hawkish. The markets did not do well. As the Fed became more dovish, or markets saw Fed getting to a pause, the markets have rallied. And in the last few days, again with the hawkish Fed, we saw a correction. So be prepared for higher volatility, as I think central banks' actions are more uncertain.
Ashish, what would be the short-term, medium-term, and long-term implications of the fact that now Indian bond market could be part of the global portfolio? Because we are looking at big numbers. That's what the numbers are floating in the morning. If those numbers of 350, $400 billion are to be believed, then, my friend, we are looking at a titanic shift in terms of inflows into India.
Yeah, so I think it's certainly a very positive and long-awaited development. there is no doubt it will lead to significant inflows into India. And again, just near term, because of inclusion in one bond index, estimates are about $22 billion coming over the next few months, a couple of $1 billion coming in every month. And as some of more bond indices follow suit, this number can go up 2-3x from here as well. I think the long-term implication is going to be, I think, the fact that we will have to be a bit more fiscally responsible and more consistent. Till the time our debt was largely internally owned, I think we had a lot more flexibility. I think as fixed income markets also get integrated with the global fixed income markets, we will need to ensure that the macro fundamentals are stable. So I think that's really the long-term implication. Short-term, of course, we know it means that there will be some boost to the currency market, some boost to the fixed income market. But really, we should realize that at the end of the day, for India, the tone of the markets are set by what RBI thinks, right? And if there are these inflows, what happens to liquidity is actually all determined by the central bank action. So even if there's inflow, the RBI can take a view of how much to sterilize or how much liquidity to get into the market. I think what this means, and the buildup of forex reserves on back of this, will also mean that RBI will have a lot more independence in running its monetary policy and not be as dictated by what necessarily happens because of global central bank action. Last 12 months have already shown that RBI has been quite independent, has not followed every Fed move, either in magnitude or direction in terms of rate. And I think as we build up the forex reserves even more, I think that will give us more confidence to drive our monetary policy based on whatever fundamentals are, what growth, inflation, unemployment is doing in India.
Ashish, we're not talking today, tomorrow, but we're talking this money coming in a year from now. And having said that, we're expected to reach the maximum weight of 10% as well. Where do you think within equities money will find its way? And is it going to be the usual suspects, banks, consumption, or you think newer pockets like defense and railways could also find, some money coming their way?
Sure. So first of all, as you know, this money directly comes into the fixed income markets, but yes, to the extent it drives the overall liquidity into the ecosystem, I think there can be flow of money into the equity market. As you guys mentioned earlier in the show, the rate sensitives are driving the market today, because it means that there is potentially an easier outlook on rates with the improved liquidity. And therefore, the traditional beneficiaries like bank, NBFCs, real estate would be the first port of call. I think to the extent that it further provides an impetus to the investment cycle and capex, the industrial names and some of the sector you mentioned will also benefit.
Ashish, now let's spend some time understanding banks, and I'm talking about Indian banks per se.
Yeah.
Whatever could go right for banks has gone right. Credit of stake is strong, NPAs are low, NIMs are great, retail banking is moving higher, UPI technology, everything is just going so right for them. Yes. So when everything goes right, we normally say that stocks are priced to perfection. Is that the challenge with banks now?
Actually, that's the good part, and I think while we struggle for valuation in many parts of the market today, fortunately we don't have that challenge in the banks. And many of the banks, if you see, even the leaders are trading at multiple that are 35% lower than their peak multiples. So I think valuation is probably the least challenging at the banks at this point of time. I think one of the reasons for that has been that the move in the Indian market has been a lot more broad-based over the last 3 years. And this has happened because it has been a broad-based economic recovery. In the last decade, we saw the move in the economy had been much more narrow. Uh, as your colleague mentioned today, there are defense names doing well. There are railway names doing well. You look across sectors and market caps, companies are doing well. So I think that has meant that there has been more choice for the investors to have investable companies, and that's meant that banks have still headroom in terms of valuations.
Now that you've changed sides from sell side to buy side, tell me which is one sell side advice you would not like to follow now that you've come on the buy side.
I think
Come on, you can be honest.
no, the only thing I would say is that on the sell side, typically we had 6 months to 1 year views on our target prices. I think in the funds that we run, the size of the funds we run, we have to perforce take longer calls. So we need to have much more multi-year views reflect in our portfolios, and really not get sucked in by the noise that is there.
Behind the backdrop, just a coincidence, is it? I can hear the noise in the studio. Can you hear it? I think it's a backdrop. We're talking about noise.
Yes.
Just a coincidence.
That's part of the capex boom.
It is.
Okay, so closing comments. From what to your mind would be the importance of next year's election? Because the election in India has been a binary event. As a fund manager who has to manage risk and also stay invested, how would you manage the election volatility?
So I think there are two things we need to take into account, right? And one is the volatility on the day of the election. And if you go back to 2004, 2009, there was very big volatility when elections results came. Election results came in a very stark contrast to what the market expectations was, and there was a big drawdown in the markets. But the reality proved to be very different. The governments that came in kind of delivered different outcomes to what the market was fearing. I think if we look today, I think whatever opinion polls that we are seeing, it does not seem that election results will provide a huge surprise. We feel that there is a significant degree of consistency that has kept into many of the policy making space. A lot of things have been made structural. So, for example, simple things like revision in fuel prices, right? So some of these decisions have become structural, have got ingrained in the policies itself. Frankly, to my mind, that is not something we are worrying about too much. I think more near term, but we are very focused on is seeing how consumption plays out in the next 6 months. I think consumption growth in India has not really picked up as expected over the last 2-3 years and has uh, lagged expectations. I think this festival season is an important time where we need to see some bit of discretionary consumption coming back in. We are also hoping that rural consumption also starts to move up. So I think pickup in consumption for me is really a space that I'm watching more closely rather than I think worries on the election.
Well, Ashish, appreciate your time and so glad to have you back on ET now.
Okay, thank you so much. Thanks for having me.